Okay. Our review, chapter 4. So far, we are talking about adjustments. And again, this is part of the whole process of GAAP. As we know, under GAAP, most companies use the accrual method of accounting. And if you're using the accrual method, that means that revenue happens regardless of when you got paid for the sale, and expenses happen regardless of when you paid for the expenses, right? So you can have situations where the action of making the sale or incurring the expense happens in a different period than when the money changes hands, right? And that's why we have to do adjustments to adjust for that separation in time. So that is really what this whole chapter is about. We know that financial statements can be annual. They can cover an entire year. They could be for shorter periods, like a quarter or a month. And okay, that's interesting. Okay, I don't know how that happened. Somebody, I mean, it's fine. Somebody started the closed captions. Is there anybody on this call? Oh yeah, there is. Okay, hello, Jeff. All right, welcome. So, as I was saying, you can make financial statements for periods for shorter than a year. And if you're going to be making a financial statement, you need to do your adjustments first so that your financial statement will be correct. So at the end of the period, you would do your adjustments for any supplies that have been used, depreciation, whatever it is that you need to adjust for, you would do that first. Then you would make your adjusted trial balance, and you could then make your financial statements, right? And that is these 3 steps of the accounting cycle: adjusting entries, adjusted trial balance, financial statements. And then after that, you just basically close out the books at the end of the year. That is the end of the cycle. So we're really just focusing on these 3 steps in the accounting cycle. I'm going to skip through a lot of these examples. Stop me if you have questions at any point. Oh yes, with every adjusting transaction, remember that there's one income statement account involved and one balance sheet account. Okay. All right, and then just as a reminder, the revenue recognition principle is what says that you count revenue at the time it was earned, not when the customer paid. And the expense recognition principle says that any expenses related to producing your product get counted as an expense when you sell the product, because you have to be able to match the revenue from the sale with the expense of the product. So if you made the product last year, but you haven't sold it yet, it's not an expense. What is that product if it's not an expense? What type of account? An asset. It's inventory. Only when you sell it can you match it up with the revenue from the sale and consider it an expense. So let's see. Okay, and then we got into the 2 different types of adjustments. We have deferrals and accruals, right? And they both apply to revenue and they apply to expenses, because both are situations where you might have the action being at a different time as the financial transaction, right? That can happen both with revenue and expenses. So where is it? I guess it's later on. Let's see, we looked at a whole bunch of examples. I'm not going to go over these again. I know that was hard enough just going through it the first time. Let's get to what I'm looking for here. More examples, lots of examples. Okay, that's what I was looking for. This is the way to remember the difference between a deferral and an accrual, right? In a deferral, the financial part happens. The dollars change hands first, and then the action, whether it's an expense or revenue, happens in another period. Whereas with an accrual, it's the other way around. The activity, which would be either the revenue or the expense, happens first, and then the dollars change hands later. Right? That's your friend for this chapter. When you get confused about, is this a deferral or this is an accrual, think about it in these terms, and hopefully that will give you the answer. Any questions so far? Okay, let's see if there's anything else major I need to cover here. Making the adjusted trial balance is really just the same as making the unadjusted trial balance. In both cases, you just take the balance of every account in the ledger, you put it into your trial balance. Some accounts have debits, some have credit balances, and if you total up the debits and credits, they should equal. So really making the adjusted trial balance is no different from making the unadjusted trial balance. The numbers will be a little bit different because of the adjustments, but that's it. And then we started to get into making the financial statements. Let me check and see exactly where we left off. I think right there. I think that's exactly where we left off. Yeah, that's exactly it. Okay. Right, where did I just put my remote? Oh, there it is. Okay, so we are going to start with this information. We have a trial balance. Is this trial balance from before adjustments were made or after? After. How do we know that? It says adjusted trial balance, right? So that means this would be step 6 in the accounting section. We've already made adjustments, and so now we just create this adjusted trial balance to make sure our debits still equal our credits, which they do. And this is magnificent landscaping. Oh, shoot. There we go. Okay. So now here's a different company. I don't know why they just changed companies on us, but now we have the income statement for a company called Printing Plus, okay? The income statement. What was the formula for the income statement? How do we figure out our net income or loss? Exactly, and that's revenues minus expenses. This company has 2 types of revenue. They, I guess, are a printing company. They print things for their clients. And that's where most of their money comes from. They provide that service. And so they're calling it service revenue. And they earn $10,100 for the month. But they also earn some interest. So they must have made a loan to somebody or made some sort of investment that earned them interest. And so that is also a source of revenue for them. It's not their main business, but it is a source of revenue. So we add those 2 together to get their total revenue. Then down here, we see their various expenses. We see their total expenses. And then you just subtract the expenses from the revenue, and you know your net income or net loss, right? Which is it in this case? The net income or net loss? Net income, because, well, it says net income, and it's a positive number. If it said net income and it was a negative number, we would know that that means it's a loss. Or sometimes it'll just say net loss. Okay, now, and this just shows where that information came from. So all of that information that's on the income statement came from the trial balance. These are the revenue accounts, and these are the expense accounts. They're always the last accounts on the trial balance. So it's pretty easy to make the income statement if you already have the trial balance, right? Then we have the statement of retained earnings. Somebody tell me what's meant by this phrase retained earnings. What is that? Profit? It is profit from a previous period. Perfect. Exactly. Because your net income is profit, right? From this period. But your retained earnings is the total profit that you've held on to. And so this is how we calculate it. At the beginning of the period, this is also for one particular month, they had 0 retained earnings. But in that month, they had net income of $4,665, which we know is profit, right? Net income is profit. So if you add their beginning retained earnings, which was 0, to their net income, you now get their total so far. But then dividends reduce the retained earnings. And somebody remind me, what are dividends?
A part of the profits paid out to the owners.
Exactly. When you take part of the profits and you give it to the stockholders or the owners of the company. And it's the board of directors of the corporation that gets to make that decision about whether or not to pay dividends. And when they do, it reduces the profit of the company because you're shifting that profit out of the company and giving it directly to the investors. You're actually giving them money. And that gives us our ending retained earnings. Okay? So it's a pretty simple formula. Beginning retained earnings plus your net income or minus your net loss if the company lost money, minus your dividends equals your ending retained earnings. And again, you can see that some of this information came from the trial balance, like dividends, but net income came from the income statement. And that's why we have to make the income statement first before we can make the statement of retained earnings, because we need to know that net income. Are there any questions so far? Okay, now on the balance sheet, notice under the stockholders' equity section, we have ending retained earnings. Where do you think that came from? You just saw it, right? The retained earnings statement. So you have to make your income statement before you can make the retained earnings statement. You have to make the retained earnings statement before you can make the balance sheet. Other than ending retained earnings, where does the rest of this information on the balance sheet come from? There's one document where we can get all of that information. Well, this is the balance sheet, right? You're close. What was that?
Sure.
Well, it came through the journal, but to one particular document.
The ledger?
It came through the journal to the ledger to a particular document. The trial balance. You're very good, Jackie. That's right. In fact, it kind of looks like the trial balance in a sense. In fact, I probably should just go the other way. I think we will see right here. So from the trial balance, we have our asset accounts, including our contra asset accumulated depreciation account. We have our liabilities. We have common stock. And that's it. Because the rest of these went on the income statement or statement of retained earnings. So all of that information we needed to fill out the balance sheet came from the trial balance. Okay. So, any questions?
If you're doing this on a computer or a program, you have to do all these reports. did, or would the computer just do it for you? Like, just want to see the trial balance.
Right, so if you're entering the data into a program like QuickBooks or any other accounting program, once you've put the data in, you can just say, show me a trial balance, show me an income statement, and the computer will generate it.
I don't have like.
Right.
Oh,
Right. So why do we spend the whole course learning how to do this? Well, so that we understand what the computer is doing, right? And we know how to interpret it. We know how to see if there's a mistake somewhere because we kind of know what to look for. But yeah, this is not really what accountants do on a day-to-day basis. Good question. Any other questions out there? Right. Well, let's move on to the next concept then. And this is not a required step in the accounting cycle. This is something that accountants might do because it just might simplify their job a little bit. And that is to make a spreadsheet. Notice it says it's a 10-column worksheet. With these 10 columns, you can have your trial balance, your adjustments, your adjusted trial balance, your income statement, and your balance sheet all in one spreadsheet. It just makes it super easy to see all the information together and how they, relate to one another. In each of those 5 documents that we see here, we have a debit column and a credit column. So 5 different documents, each with 2 columns, is where we get 10 columns, right? So let's take a look at this in more detail, starting with the first 2 columns. This is the unadjusted trial balance. It just says trial balance, but we know it's the first one. It's the unadjusted trial balance. And it really looks the same as a trial balance document. We have all the accounts listed. We have a debit column and a credit column, and they equal. So it's the same information that would be on the unadjusted trial balance. It's just in a spreadsheet, like Excel. So that's pretty straightforward. And then, oh yeah, so this is the unadjusted trial balance. So again, same information. Just the format looks a little different, okay? But it's really the same. So then we could make our adjustments. Let's zoom in here because I know that's kind of small. Okay. Zoom in. Now let's see what adjustments have been made. The company realized that there's some interest that it's going to receive money for. So they made an adjustment and they debited interest receivable. And then if we go down, we should see a corresponding credit for interest revenue right there. See? On the credit side, interest revenue, that goes with the interest receivable. So remember that adjustment would have been made in the journal. Then the debit and the credit would have been copied over to the individual accounts in the ledger. One of those accounts was interest receivable, which is an asset, so it's up on top. The other one, the interest revenue, is a revenue account, so that goes down towards the bottom of the trial balance. So that's why you don't see them next to each other. But that's just one of the adjustments. Here was another one for supplies. We credited supplies $100. And then if we go down a bit, we can see supplies expense being debited. Right? So those match up. And that was one of the adjusting entries we've seen before, right? When you used your supplies, you have to then do an adjusting entries. Let's see what other adjustments do we see here. How about that $75 one? What is that for? Yeah. We took depreciation. At the end of the period, we have to say, okay, how much depreciation do we apply to this long-term asset? So there was $75 of depreciation on our equipment. And if you remember, we have to credit accumulated depreciation. We see that up here. That's up here with the assets. Does anybody remember what type of account accumulated depreciation is? Contra asset account, right? So it's an asset type of account that actually reduces the value of our assets and it increases over here on the credit side. The only type, well, contra asset accounts would be the only asset type of accounts that would increase on the credit side. And so we see it matches up, right? $75 credit goes with the $75 expense. That's on the debit side. We also have a $600 transaction adjustment. What was that for? $600. Yeah, exactly. Unearned revenue. So what happened to that unearned revenue? Did it go up or down? What type of account is unearned revenue?
Liability.
Yeah, see, it's here with the payables. It's a liability. That word unearned always tells you it's a liability. And liabilities increase on which side? Credit. Now this is debited, right? That's a debit. So that means it's going down because liabilities increase on the credit side. If there's a debit, it's going down. Why would our unearned revenue be going down? We did the work. Now we have earned it. And that's why we have a corresponding service revenue getting credited. You know, liabilities are not part of deal. Revenue is also not part of deal. So both of those accounts increase on the credit side. And that's what happened with service revenue. That's an increase. And decrease on the debit side. And that's what we see here. This liability is decreasing. So we can see all of this just in these four columns. Right? We see the original balances. We see the adjustments. Now, let's add another two columns. Now we have our adjusted trial balance. Okay. So now with the adjusted trial balance, we're just taking the original amounts. Like, here's an example. We had supplies. Originally, there were $500 worth of supplies, right? That's an asset. So normally we'll have a debit balance. But then we reduced it by $100 because we made an adjustment. We saw we used some supplies. And so now we have $400 remaining, right? The $500 debit minus the $100 credit leaves us with a $400 debit balance for supplies. Does that make sense? Let's look at another adjustment here. And this one, unearned revenue. Again, that's a liability. It has a credit balance. So that means previously we owed $4,000 worth of work. We did $600 worth, so that decreases it with the debit. And now we have $3,400 credit remaining. That's how much work we still have to do. You can see quickly and easily the relationships between these documents, right? Trial balance, the unadjusted adjustments, and then adjusted trial balance. Okay. Any questions? All right, well, next, well, there's our adjusted trial balance. You can see what it would look like if it were actually printed out. Again, it's the same information we just saw, right? It's the same as those two columns on the right. You just take those numbers from those two columns format them like this, and you've got your adjusted trial balance. Now let's add the income statement. Notice there's not a lot going on in these top rows, right? Why would that be? Why would our income statement information not start until down here? That's right. The income statement is revenue and expenses, and those are at the bottom of the trial balance. So if we scroll down, that's where all the revenue and expenses are. Remember, the company had two types of revenue. They had their service revenue and they had their interest revenue. And then these are their 4 different expenses that they have. You add up all the revenue, subtract the expenses, we get their net income. And then you see we balance. Okay. So you can see everything at a glance. And then the last 2 columns would be our balance sheet. Oh, there's the income statement, right? When it's nicely formatted, same data, just different format. So here is the balance sheet. All right, and so the balance sheet does include all these assets up here. Notice that the numbers haven't changed. We just took the numbers that were on the adjusted trial balance, and they're exactly the same on the balance sheet, right? For the assets, for the liabilities here. Actually, sorry, assets go to there. You have the liabilities. Then equity is common stock. Again, it's the same number. Now, here's where it is different though. On the balance sheet, you're not going to find revenue and expenses. You're not going to find dividends. Well, we do in this case. But where do the revenue, expenses, and dividends show up on the balance sheet? They show up through retained earnings. Because remember, the retained earnings statement, you take your beginning retained earnings, add your net income or loss, which is based on your revenue and expenses from the income statement. You subtract your dividends and you get your ending retained earnings. Remember that? So really, your revenue, expenses, and dividends all give us our ending retained earnings. And that goes on the balance sheet. So we don't have that here because I don't think there's a place for it. But we can see the information. Let's see. Okay, so remember these last 2 columns are the balance sheet. And by the way, you're not going to have to do this on the exercise set well, obviously we finished the exercise set, but also not on the problem set. This is really just more for you to understand how you could use a spreadsheet to track all this information, and hopefully going through this process helps you see how everything sort of fits together. So if these last 2 columns over here are the balance sheet information, we had the total of our debit accounts, let's see, and then the total of our credit accounts, and they do balance. But to get them to balance, we have to include this $4,665. That was that net income from the income statement, right? Which would be part of the retained earnings. So even though normally on the balance sheet, it will be a little bit different, we really see the same thing. We really see the net income minus the $100 in dividends. That is our retained earnings. It's just not displayed exactly the same way. But as an accountant, you know, you can kind of still find that information there. So how would we make the balance sheet? We would just take all of that, all of this data, the assets, the liabilities, and the equity accounts. We can use that to make our balance sheet, with the one exception, this ending retained earnings comes from this retained earning statement, right? Which has the net income and the dividends already built into this number. It goes right there. All of these other amounts all just came from the adjusted trial balance. Okay. Is there anything that you would like clarification on? Any questions out there? Annette?
Can you remind me what a one underline and the two underline mean, the normal balance with the one?
So it's basically just like here.
Yeah, that, or the one right above it.
So the double underline is like a total balance, basically your bottom line result. This basically just says that, you know, this is the product of these previous numbers. So in this case, we're adding, sometimes we're subtracting, but the line just tells you equals. Yep. We see the same thing here. We see the double underline at the very bottom to show that's the grand total. Right, good question. Any other questions out there? Okay. All right. Oh yes, so let's look at this example. What amount of net income or loss does Frank have? This is Frank's investment advisor company. And what will be their ending retained earnings balance? Okay, so let's, obviously that's pretty small. So let's zoom in on this one. Okay, we can't see the labels on top, but we know the first two, well, I'll quiz you. What are the first two columns?
One is trial balance.
Okay, so the first two columns are the unadjusted trial balance. What are the next two columns after the unadjusted trial balance?
The adjustments.
The adjustments. And then what are the next two columns? Adjusted trial balance, right? And then the next two? The income statement first, and then the last two are the balance sheet. Okay. So if we look at these two columns here, these two. Now notice they don't match. They didn't give us all of the information. We're gonna have to do a little bit of calculation here on our own. So ignore these first 6 columns. Okay, let's just look at these two. And let's see what's going on. We know that these two columns are the income statement, right? So we have revenue and we have expenses. This is the revenue. The company has only one revenue account. And then these are the expenses. Now notice the revenue equals 55,100. The expenses equal 55,800. So what is this company's net income or net loss? Was that? Exactly, they lost $700. Their expenses here are $700 more than their revenue. Okay, so we had to do that calculation ourselves, but we see they have a $700 loss. Do you think that might explain why we also see a $700 difference here between debits and credits on the balance sheet? Yes, because that $700 loss has to go on to the retained earnings statement and then get added to the balance sheet as a reduction in retained earnings, which would then balance out those two accounts. Okay, so that's the part that you have to figure out, because you're not gonna see that on the trial balance. You need to go through the retained earnings statement to figure out how much the retained earnings have changed. All right. Does that make sense? Kind of, sort of. Oh, wow, I didn't know I could do that. That's pretty cool. Okay, great. Well, that brings us to a problem. So let's tackle this one, problem number 2. Pause the recording here. Let's summarize what we have learned in this chapter. All right, so previously we had learned the first 4 steps of the accounting cycle. What was the very first step in the accounting cycle? Where do you start?
Core transaction.
Yes, identify and analyze transactions. Perfect. Then what do we do after that? Journal. Then step 3 is the ledger, right? Step 4, what was step 4? Unadjusted trial balance, great. Then we get to this chapter, and step 5 is what? The adjusting entries. Step 6. Adjusted trial balance. Step 7. You make your financial statements. Perfect. All right. So that's what we learned. Those 3 steps, and let's see what else. Adjustments are needed to update records that might not have original source documents. Sometimes they do, but sometimes you just have to remember that, hey, when this happens, we need to do an adjusting entry. When we count our supplies and see that we've used some supplies, we have to go into our accounting records and do an adjusting entry. When we get to the end of the year and it's time to take depreciation on our long-term assets, we need to make those adjusting entries. Why even bother taking depreciation? What benefit does it provide to a company to depreciate their assets? Anybody know? Exactly. When you calculate a depreciation expense, it counts as an expense, it reduces your profits, but that saves you some money on your income taxes. So when we get to the long-term assets chapter, we'll see that companies sometimes like a slower depreciation, so they look more profitable, and sometimes they like a faster depreciation, so they pay less in taxes, right? There is a little bit of discretion that accountants can use in making that decision. So yes, we have to do some adjusting entries. We just have to remember to do them at a particular time. Every adjusting entry will have an income statement account and a balance sheet account. And as we saw at one point on Monday, when you're doing the adjusting entry itself, there is no cash in that transaction. There will be a corresponding transaction that will have cash. But remember that the whole reason for adjusting entries is because the money changing hands is happening at a different time as the action, right? So when that action occurs, there will be no cash in that transaction. And I think that is it. Double check. Oh, well, there's a little more. Okay, sorry. Let's see. So we did see some examples, like there was one exercise we did where, remember, we looked at the trial balance and there was a place on the trial balance for salaries payable, but there was nothing in the data. There were no salaries payable until we made an adjusting entry, right? So sometimes when you make an adjustment, an account that previously had a zero balance now has a balance. So what you'll find is when you make your adjusted trial balance, there may be some accounts on there that were not on the unadjusted trial balance because they previously had a zero balance. And now that you made the adjustments, they have a balance and they do show up on your adjusted trial balance. Let's see, what else? We also looked at the 10-column worksheet, right? Where you can have both your unadjusted and adjusted trial balances, the adjustments in the middle, your income statement, and your balance sheet, all on one document. So that is it. That is everything we covered. All right, and we're done with the chapter 4. I'll stop recording here.